Good afternoon. This is a presentation of theory of interest. So today I'm going to talk about bond valuation. Issuing bond is one of the simplest ways for a company or government agency to raise capital. Instead of issuing bond, the organization may go public, for example, to issue share to raise more capital. In another hand, bonds considered more secure to investors. The reason is because usually bonds will staggered maturity date with a guaranteed return rate. For those bondholders are actually act as creditor to the company. That means when the company go bankruptcy, the bondholders have the priority to get their money back. So in this topic, we are more interested in finding the price of bond. There are four methods to look for the price, which are basic formula, premium discount formula, base amount formula, and Markham's formula. Four formulas are actually give the same answer. So we look at the first example. A 10-year £1,000 value bond bearing of 8.4% coupon rate payable semi-annually and redeemable at 1,050. It's brought to yield 10% convertible semi-annually. Find the price, verify that all four formulas produce the same answer. So we come to the table. We write out all the information given from the question. Then we substitute all the information into the four formula. You can see the answer we get from the four formula are exactly the same. So let's look at the question. John buys a 10 years £1,000 value bond with coupon at 10% convertible semi-annually. The price of the bond to earn a yield of 8% convertible semi-annually is ringgit 1,422.45. The redemption value is more than the par value. Calculate the price John would have to pay for the same bond to yield 10% convertible semi-annually. So as previous, we write down all the information getting from the question. Then we know that the redemption value is greater than par. So the first thing is we have to find the redemption value. Using the first formula, we calculate that the redemption value is 1,649 ringgit and 77 cents. So the question asks, calculate the price John will have to pay for the same bond to yield 10% convertible semi-annually. So the I is equal to 10%, but because of semi-annually, we have to divide by 2 is equal to 5%. Then we substitute all the information into the same formula, which is the basic formula. We calculate that the price is 1,244 ringgit and 89 cents, which is C is larger than L, so we know that this is a premium bond. So bond can be priced at premium, discount, or at par. So that means bond sell at par means that the bond sell at 1,000 ringgit. Bond sells at premium means that the price is higher than the redemption value. Bond sell at discount means that the selling price is less than the redemption value. So we will look at amortization of premium bond and accumulation for discount bond. Look at the example first. We know that this is a 2.5 year maturity bond and the coupon rate is 9% pay semi-annually, so the coupon rate will be 0.45%. And the desired yield is 8%, so the I is 4% because semi-annually. Now we have to find the bond price to determine this is a premium bond or a discount bond. So we're using the information and we substitute into the first formula. We calculate that the selling price is 1,022 ringgit and 25 cents, which is more than the par value, so this is a premium bond. And look at the coupon rate here. It stated that we will get 45 ringgit as the interest, but however the actual interest that we count is 40 ringgit and 89 cent. That means we actually lost 4 ringgit 10 cent in this coupon. So the column of amount for amortization of premium, we sum up this column, we know that this amount is the amount that we lost to invest this bond. So look at another example. Same as previous, we calculate. First thing, we have to find the book value, which is the bond selling price, and we're using the information and substitute into the formula. We get the selling price is 978 ringgit and 35 cent, which is smaller than the par value, so we know that this is a discount bond. Then we look at the coupon here. It's also 45 ringgit, but the actual interest that we count is 48 ringgit and 91 cent. You can see the amount for amortization of premium, the column here, all the figure is negative. That means the company have to add back this amount with the coupon rate to pay the investor. So when you sum up this column, the amount will be the amount here will be the amount you gain from this bond. So next, look at the question. A bond A 1000 bond redeemable at par on 1st of December 2018 with 10% coupon rate, pay semi-annually. The bond is bought on 1st of June 2016. Find the purchase price and construct a bond amortization schedule if the desired rate yield is 12% compounded semi-annually. So look at this table. We construct this table. We know that this is a 2.5 year bond, which the coupon rate is 5%. So the first thing we have to do is finding the selling price to determine whether this is a premium or discount bond. So we substitute all the information into the formula. We get that this bond is sell lower than the par value, so this is a discount bond. And we can see that the interest earned is higher than the coupon rate, so when you invest in this bond, you will get higher return. So next, let's look at stock and money market instrument. Stock are financial instruments that make the holder a co-owner of the company that issued them. Stock do not involve the repayment of a debt or the payment of interest. We will introduce two types of stock, which are preference stock and common stock. For preference stock is a type of security which provide a fixed interest rate of return. Preference stock is an ownership security. In general, stock do not have maturity date, and preference stockholders do not have voting right and they do not run the business. However, the preference stock have priority to get back the money when the firm go bankruptcy. So when company liquidated, the company has obligation to pay back the debt holders. Then is the preference stockholders, and the last will be the common stockholder. So for common stock, it is another type of ownership, and common stockholder are the one running the business. They have the voting right to choose the management to represent them running the business. However, the common stock do not have the fixed interest rate. The interest rate is set by the board of directors. Whether to give them higher or lower interest rate will depend on that year business performance. After we talk about the two types of stock, we talk about buying stock. Let's look at the question first. A common stock is currently earning 6 ringgit per share, will pay 3 ringgit per share in dividends. At the end of current year, assuming that the earning of corporation increase at the rate of 4% for the first 5 years, 2% for the second 5 years, and 0% thereafter. Assume that the corporation plans to continue to pay 50% of its earning as dividend. Find the theoretical price to earn an investor an annual effective yield rate of 10%. So look at the answer here. We write down the first thing is 3V plus 3 multiply 1.04. The 1.04 here is the first interest that the company promised to give. Then we multiply with V power 2 until we add 3 multiply 1.04 power 4 and V power 5. V power 5 here means that this is the first 5 year interest rate. Then he say 2% for the second 5 year. The second line here, so we write 3 multiply with 1.04 power 5. This is the first 5 year interest rate, so it will remain here. Multiply with V power 6 plus 3 multiply with 1.04 power 5 multiply with 1.02. The 1.02 here is the second interest the company will promise to give, and multiply with 3 power 7 until 3 multiply 1.04 power 5 multiply with 1.02 power 4 and V power 10. So this is until the first 10 year interest rate. Then the question say, and 0% thereafter. So you plus 3 multiply with 1.04 power 5 multiply with 1.02 power 5, and you have to multiply with V power 11 plus V power 12. Why? Because after starting from the year 11, the company will not given interest, but this interest will remain until the end of the day. So we form an equation from the information above. We calculate that the share price is 36 ringgit 67 cent. So now we talk about buying stock. One of the way to buy stock is by buying margin, which means you borrow money from third party to buy stock. However, there are risks associated to buying stock on margin because the stock price always uncertainty. You do not know the stock that you buy the price will go up or go down. So by law, the brokerage firm will not be allowed to let the value of the collateral go down below a certain percentage of the loan value. The percentage is called the maintenance margin. Maintenance margin is the minimum amount of equity that an investor must maintain the margin account after purchase has been made. If the stock drop below the set amount, the brokerage firm will issue a margin call on your stock. Margin call is the money that you must add to the margin account after trading loss in order to meet minimum capital requirement. Then we have two situations. One is called under margin. Under margin happen when your actual margin is smaller than your maintenance margin. Then you will receive a margin call from the broker, and you must take corrective action. If you fail to do that, the broker has the right to close down the account. The second situation is over margin. Under over margin, the investor can decide whether to take out the money or invest more. And then for the buying process, it will be involved but bid price and ask price. Bid price is the price for broker to buy it. Ask price is the price that broker to sell it. From the investor view, ask price usually is the price that you wish to buy the stock. Bid price will be the selling price of your stock. However, whether you're selling or buying the stock, an additional charge will be imposed. Let's look at the question. NBF stock has a bid price of 12 ringgit 65 cents and ask price of 13 ringgit. Assume there is 0.1% brokerage commission on the bid price. So we calculate what is the answer. For A, the amount you will pay to buy the 50 share. So it's 13 ringgit times 50 share, you get 650 ringgit. But don't forget, there has the commission imposed. So you have to use the 650 ringgit multiply with 0.1%. Then you get the 65 cents. So this figure you add together, then we will get 650 ringgit and 65 cents. This is the amount you have to pay to buy the 50 share. B. What amount will you receive for selling 50 share? The selling price is 12 ringgit 55 cents times 50 share. So we will get 632 ringgit and 50 cents. But you have to add another 63 cents because of the commission. So this figure minus this figure, you will get 631 ringgit and 86 cents. This is the money you will get after you selling your 50 share. So we need to calculate a round trip transaction cost. Then you use the 650 and 55 cents minus the 631 ringgit and 86 cents. You will get 18 ringgit 78 cents. This is the total cost incurred for the round trip transaction. So we look at another question. John wants to purchase 100 stock of XYZ. The current price of stock is 100 ringgit. He has 4,000 on hand, so he decides to borrow another 6,000. The broker charged an annual effective rate of interest of 10%. Suppose the stock goes up by 20% in 1 year period. So we calculate. Okay. What is the year-end value of the share? The year-end after 1 year is you using the price 100 stock multiply with the 20% because the growth rate is 20%. So it's 1,000 times 1.12 will equal 12,000. So B. Find the total of loan payment and interest. Because you can see from the question, the total share actually is 1,000. Now you want to buy is 1,000, and your personal equity you only have 4,000. Then another 6,000 is you borrow from the bank. So the interest on the loan is 10%. So you're using the 6,000 multiply with 1.1, you will get 6,600. And third, what is the return of rate? The return of rate is you using the rate and you calculate is 35%, and the return if not buying on margin is 20%. So that's all for the presentation.